Hello, everyone. My name is Cristián Lefevre, Chairman of EY Chile and President of the Institute Director of Chile. We will wait a few seconds before starting for a participant to connect. Well, welcome to our webcast Shareholder Activism Challenge for Boards. Shareholder activism continues to play a critical role in the global markets. Not all companies will be targeted, but no company is immune. To discuss what attracts an activism investor, what their objectives are, and how companies' board can help management prepare and respond, joining us today, David Hunker, EY America Shareholders Activism Defense Leader, and Agathe Porte, board member at IdDC. David leads EY LLP Shareholder Activism Defense Practice, advising clients on preparing for and responding to shareholder activism. David spent over 17 years as an investment banker at leading bulge bracket firm, founding and leading its global shareholder activism defense practice, where he advised on some of the highest profile activist campaigns around the globe. Agathe has 30 years of international experience in marketing and communication, founder of the multidisciplinary agency Proximity Chile. For more than 6 years, she was the CEO of the BBDO, Proximity Group of Agencies, subsidiaries of Omnicom Inc., the world's leading advertising and communication group. Agathe has been named Executive of the Year by the Capital magazine and distinguished on more than one occasion as one of the 100 women leaders by El Mercurio. She is a director certified by the UK Institute of Directors, board member at BNP Paribas, Cardiff, Chile, ICARE, and the Institute of Directors. As you can see on the screen, David will first present about shareholder activism, and then we will have a panel discussion. And at the end, we will have a few minutes to answer your question and comment, which you can send throughout the transmission through the Q&A. David, welcome to our webinar.
Thank you, Christian. I'm going to share a screen with you and walk through a presentation. Give me
1 second. Yeah.
There we go. So can you see the screen?
Mm-hmm. Yes,
perfect. So thank you for that introduction, and thank you for having me today. And really am excited to share with you, our perspectives and my perspectives on shareholder activism. As Christian said, I've been leading one of the leading shareholder activism practices on Wall Street for the past decade, prior to joining EY in the last 7 or 8 months, and have seen over that period of time the evolution of shareholder activism from what originally was primarily a US issue, a US-based strategy, hedge fund strategy, targeting primarily US-based companies, to one that has expanded globally into Europe, into Asia, into Africa, into South America, into Australia, and a strategy that really has become a permanent part of the global capital markets, and one that every board, every senior management team at every publicly traded company around the world should be knowledgeable about and prepared for. So there we go. So just to provide some perspective, you know, on this page, you can see kind of the rise in overall shareholder activism activity outside of the US. These numbers are all non-US numbers. And you can see really a peak in 2018. I would not read too much into the pullback that you see on the left side in 2019 and 20 because of all of the issues that we were seeing around the world, particularly related to COVID. The activist activity globally, including in the US for 2020, was artificially depressed. But what you can see is, you know, fairly significant, you know, increase from, you know, 2015, 2016, 2017, 2018 in activist activity, as, you know, a couple of things were happening. Right? One, you know, the large global shareholder activists, again, many of those activists, hedge fund activists, are US based, but they were running out of opportunities in the US in terms of targets. As the US equity markets rallied over a sustained period of time, there weren't as many, you know, value arbitrage opportunities in the US for activist hedge funds to target. And so you started seeing those activist hedge funds look elsewhere for opportunities, and elsewhere being, you know, Europe, South America, Asia, Australia, etc. And so you started to see this evolution of activism looking elsewhere. Secondly, I think what you saw as activists, the large hedge fund activists that with names that you're probably familiar with, Starboard Value and Carl Icahn and Third Point, as they began having successes outside of the US, non-US companies, we started to see the development of local activists. So European activists, activists focused on you know, South and Central America, activists focused on Asia, domestic activists starting to target more domestic companies. So this is really a trend that has shown durability. It's a trend that has shown that it's, like I said at the beginning, a permanence in the global capital markets, and one that evolves fairly rapidly in terms of what exactly it is that activists are after, right? And we're going to talk in a couple of minutes around how activists target companies, what they're trying to achieve, what makes one company particularly attractive to an activist versus another. And then, you know, when we're done with the presentation, again, I'm happy to take questions from any of you. And then on the right side of the page here, I think the takeaway is, listen, this is not a sector-specific issue either. Activists are very active in all sectors across the board: consumer, financial, healthcare, industrials. And one thing that I will say is a lesson learned that we really learned in the US first is that activists are willing to also target regulated companies, highly regulated industries. So in the US, you know, financials, energy producers, utilities, all of these are kind of highly regulated by the government, but activists have proven willing to target those companies. Also, kind of, we've seen a willingness of activists to target companies where there are large insider holdings, maybe sometimes a large strategic holder. In some instances, we've seen activists target companies that quite literally were controlled companies, meaning that you know, a shareholder friendly to the management team, friendly to the board, controlled more than 50% of the vote, and there was no mathematical way that an activist could force change. But an important thing to remember about activism is one of the most powerful tools that an activist use is that public spotlight. right? It's not about being able to force change every time with a vote, but being able to cast a flashlight on the company in a way that in some ways is embarrassing for the company. And that's a tool that activists will use is public embarrassment in an effort to get the company to make some sort of a change. And so what we've seen, even in controlled companies over the last 7 or 8 years, there have been over 24 companies that have been targeted by activists where friendly shareholder, friendly to the company, controlled the shareholder vote, but an activist in 2/3 of those situations was still able to get the company to effectuate some sort of change that the activist was calling for, simply because the company wanted the activist to go away, not because the activist could mathematically force any change in the shareholder vote. So why is all of this happening, right? And how are activists able to be so powerful today, particularly given that most shareholder activists today are buying relatively small stakes for themselves, right? So the typical shareholder activist today is only buying 3 or 4% of the company's shares before they launch a campaign. And in the US, that number is even lower, but on average, about 3 or 4% globally before they launch a campaign. How are they then able to effectuate such change? And it's really what you see on the right side of the page here. The global institutional investors have embraced activism over time in a way that allows activists to recognize that they have significant levels of support from most companies' shareholder bases. So when we think about an activist like Starboard Value, or we think of an activist like Carl Icahn, what they know is if they show up at a company and they launch a public campaign, there's a very large block of these global institutional investors that from day one, before they really even understand the activist thesis, are inclined to support that activist just based on past history, based on their relationships with that activist, based on their past experience when that activist has targeted one of their portfolio companies. So when you look at the numbers on the right-hand side of the page, I'll pick out BlackRock, the second from the top. In 23% of situations where an activist has targeted a company and that activist campaign has gone to a shareholder vote, BlackRock has voted in 23% of those situations with the activist, right? Basically has voted to vote out a company director and vote in an activist director. Right? And I think this number surprises a lot of people, particularly for names like BlackRock, Vanguard, State Street, Wellington, the index funds, who are often viewed as more company friendly. But in fact, those names are increasingly activist friendly, as you can see. And what I think an important thing to keep in mind with this data set in particular is this is across all activists, right? So this is Starboard Value, Carl Icahn, Third Point, every as well as activists you've never heard of, Fog Lamp Capital, right? So that's probably a name that most of you have never heard before. But when you just limit this data to those activists, what I call tier 1 activists, which is the name brand activists that you read about in the Wall Street Journal, if you just limit it to those more reputable activists, BlackRock, the index fund, is voting with those activists more than half the time, right? And so this is really kind of where we start the discussion on how activists have been able to be so successful. It's because of these institutional investors on this page that have said, hey, we're willing to support shareholder activism. We're willing to support individual shareholder activists because we, as shareholders of these companies, aren't happy with the status quo, and we want to see change. Again, it's just a few more stats around global shareholder activism. You can see over a longer period of time. Again, very early when I started the shareholder activism practice at the bank that I was working for a decade ago, 99% of shareholder activism activity was in the US. The last couple of years before the pandemic, I was probably spending at least half of my time with clients outside of the US, in Europe, in Asia, Africa, South America, helping them, Australia, helping them understand, what this activism thing was that they're seeing and how to prepare for it. Again, this is a strategy that only is going to continue to increase, particularly outside the US. It's a strategy that, again, that management teams and boards must be prepared for, and we're going to talk about this a little bit later. But that's really the key takeaway from this whole discussion today is we need to be prepared. We cannot wait until an activist shows up and is knocking at our door and making demands before we start thinking about this. There are things that we can do today to make ourselves less vulnerable, to make it less likely that an activist is going to show up and target us. And to do that, we have to understand what vectors of attack an activist would use to target us. And again, we're going to talk about that in a little while. But thinking proactively about shareholder activism is really the best way, and in some ways a better strategy than simply performance, surprisingly. And I can talk about that. But being prepared and being proactive, particularly with respect to how we engage with our shareholders, is really the best way to limit our vulnerability to activism. So some of the recent trends in shareholder activism in terms of broader changes. Again, activism is a strategy that evolves almost every year. From the very early days of shareholder activism, the very first shareholder activists were really the old corporate raiders, right? So Carl Icahn, Ralph Whitworth at Relational, these were the investors that 20 years ago were going and buying companies and massively cutting costs, laying off employees, levering the balance sheets up, and then exiting, and that's how they made their money. But those same individuals realized they could make a lot of money not by buying companies, but by buying small stakes in companies and agitating for change and having to put less capital at risk. But so that's really kind of the early days of activism, and then over time, almost on an annual basis, the strategies that activists have deployed, the demands that activists have put to companies have changed. Today, one of the primary demands that most activist campaigns focus on is around strategy and M&A. So activists aren't saying you should run the company better. Activists are saying you should sell the company. You should break the company apart. You have these three disparate businesses that don't have any natural synergies. Why don't you sell these non-core businesses to someone that can value them more than shareholders do today, or someone that can operate them more efficiently than you can operate them today, and thus is willing to pay more for them and crystallize value for shareholders today. Again, in the early days of activism, activists were focused on operating the company better, improving margin, improving top line growth. Today, it's much more focused. The vast majority of activists are focused on shorter term actions that can create value for shareholders in their mind. And that primarily falls to M&A. And then ESG. And we're all hearing a lot about ESG. We're reading a lot about ESG, including diversity, sustainability, inclusion. And you may wonder, well, how is ESG an activism topic? How can an activist create a story around shareholder value creation with respect to ESG? And it's a very good question. I think the short answer is they can't, right? It's very difficult to directly draw a line between a company with shareholder friendly or world friendly ESG policies, societal friendly ESG policies, and shareholder value creation. But the index funds in particular, again, BlackRock, State Street, Vanguard, they view themselves as the ultimate long-term holder. Their holding period is, in theory, indefinite. And for many of these index funds, their perspective is, I don't know how being a socially responsible or an environmentally responsible company, I don't know how that drives value today or tomorrow or a year from now or 3 years from now. What I do know, and this is from BlackRock's perspective or the index fund's perspective, what I do know is over 25 years, over 50 years, over 100 years, companies that are environmentally and socially responsible. You think of the oil and gas space, a environmentally responsible energy company that is pivoting away from oil and gas, right? They're going to have less shareholder litigation. They're going to have less environmental litigation. They're going to have less liability around cleaning up from some big oil pipeline spill. And the index funds believe heavily that that will create shareholder value. They don't know how much, but they believe almost as if it's religion. They believe that it will, right? And so activists take advantage of the things that are important to the shareholders that are important. And again, we talk a lot about index funds, these passive investors. Why are they so important? Well, because for your average publicly traded company, these are the investors that are at the top of your shareholder register, right? In the US, for your average public company, index funds hold 30% of the vote, right? And so activists are capitalizing on these issues that are important to shareholders who ultimately vote, right? Because at the end of the day, if they do want to try to force some sort of a change, if they do want to try to replace directors, they're always thinking about votes. And one of the things that I very often tell clients and even tell colleagues is, listen, don't think about shareholder activism like an intellectually honest debate around shareholder value creation. It's not. Think about shareholder activism as if it's theater and politics, right? Shareholders or shareholder activists are telling a story to shareholders to try to win their support, to try to win their votes, right? And that story oftentimes doesn't really make a lot of sense to the management team. It may not make a lot of sense to the board. Hey, you're saying we should do this, this, and this. Well, gosh, you must not know a lot about our business, because here are all the reasons why these things don't work. But keep in mind, shareholders understand the business up here, right? Management understands the business down here. So activists are targeting their arguments at this kind of 10,000 foot levels where shareholders understand the business. And so this is an area, again, where ESG can really come into play. Again, because if I'm an activist and I have this idea around a company I want to target, I will find these ESG issues to throw in there in order to try to shore up the support of the index funds, because I know those issues are important to them. And again, what do I mean when I say this? It's not a debate around shareholder value creation, because these activists are talking about the value creation that can come from, if the company would just do these three things, look at all this value that would be created. When we go back to this idea of strategy and M&A, again, keep in mind, an activist may say, you should break the company apart, right? You should sell these non-core assets. M&A transactions take time, right? For a large company, an M&A transaction can take 18 months, 24 months from the time the company starts evaluating that transaction to the time it actually closes, right? The average activist hold period over the last 5 years is 9 months. So what an activist does when they come in and they're saying you should sell the company, is they're waiting for the company to say, okay, the board or the management team is going to form a committee to evaluate the sale of the company, or evaluate the sale of these assets, or potentially even announce a sale of some assets. But there's a long period of time between when a company announces a transaction and when that transaction actually closes. You have a bunch of diligence that's happened. You have to potentially run it through antitrust review, regulatory review. There are lots of different things that can happen between announcement and closing to derail a transaction, right? But an activist will sell out of their position when that transaction is announced. So what they're looking for is, hey, from an activist perspective, what I'm doing is I'm getting shareholders excited about all of the potential value creation that's out there. And when I get shareholders excited, they start bidding the share price up. right? And then the company announces that they're going to form a committee to review strategic alternatives, which, you know, on Wall Street is just code for I'm going to try to sell the company. And that drives the share price a little bit higher, right? And that's when the activist exits their positions. That's when they sell, right? And so again, it's about the story they're telling. I said it's about theater and politics. It's that theater, the storytelling around value creation, not so much around I'm going to stick around if I'm the activist until you actually sell the company, until you close the transaction. Very few activists stick around until the closing of the transaction. And then one other point I'll touch on this page is settlement. You see that on the bottom right-hand side of the page. Settlement has really become the preferred outcome in many of these situations. And what does settlement mean, right? It means the company and the activist coming to some sort of an agreement, not necessarily on the outcome, what the company is going to do, but coming to an agreement on how they can potentially work together to basically figure these things out. You know, very, very often the form of a settlement would look something like this. The company and the activist agree to settle. As part of the settlement, the activist will receive 2 seats on the board, but no existing directors are coming off the board. You know, before the activist showed up, we had 9 directors. We're going to expand the board by 2. Now we have 11, and we're going to put 2 activist nominees on the board. In connection with that, the board will form a committee to evaluate these 4 things. And that's kind of what a settlement looks like. So what does the company get out of a settlement? Well, they get the campaign is over. All of the public fighting, all of the public criticisms that are coming from the activists end, right? What does the activist get out of a settlement? Well, typically when a settlement occurs, there's still a continued uplift in the share price because shareholders believe that something's going to happen after the settlement. And oftentimes activists also get reimbursed for all of their expenses for running the campaign. So it's all part of kind of the written settlement agreement between the company and the activist. And so, you know, folks feel like they have a win-win. And keep in mind that from an activist perspective, there are multiple ways that an activist can make money, right? An activist can make money through the campaign, but for a newer activist, particularly in a new market, so you think about a domestic hedge fund in Chile that is this is their first activist campaign. It's very novel. You know, one of the things that new activists or new hedge funds are always thinking about is, how do I raise money for my next fund? And so a very typical tactic, particularly for newer funds, we see it with established funds fairly frequently as well, but for new funds is, I'm going to settle this campaign, I'm going to get 2 board seats, but then I'm going to use this as an example when I go out and try to raise capital for my main fund. I don't want to manage $200 million. I want to manage $2 billion and earn a management fee on that $2 billion. I'll use this example when I'm raising that $2 billion fund to say to potential investors to my fund, look, I can be effective. When I showed up at this company, they took me seriously. They put me on their board. You should give me money for me to go out and target other companies. I already have a track record of success. And so again, there are different agendas that different activists have. So it's very important that, listen, I'm talking a lot about activism as if it's one strategy. It's important to understand that activism is really about the individual activist. Who is the fund manager, the head of that activist fund, and what are their motivations, and what's their strategy, and what's their ego like? So I'm talking generally about activism, but just keep in mind that there's more than one way for an activist to. Just a few examples of campaigns recently, kind of around the world. You know, again, quite a bit of activity. Prior to the pandemic, we had just tipped over half of shareholder activism activity happening outside of the US. And again, some additional kind of global activists. You see some very well-known names on here in Japan, you know, Toshiba, Nintendo, you know, Europe and the Nordics and Brazil. So again, it really is a global strategy. So we're gonna transition into kind of what attracts an activist, you know, to a company. and talk about that for a while. And then we're going to talk about, some activism preparedness and response strategies. So what really is going to attract an activist? There are two ways to think about this. When an activist is deciding what companies to target, they're going to do a couple of things. They kind of look at targeting in two phases. One is a more quantitative phase, where they're pulling a lot of data for publicly traded companies and saying, hey, I want to look at companies that meet this profile, if you will, of performance, share price performance, valuation, particularly valuation versus their peers. And so when you look at performance, those are the types of things that I'm talking about, the types of things that can end up on an Excel spreadsheet, right? Once an activist has identified those issues, again, share price performance, valuation, it could be corporate structure. Do they have multiple divisions that don't make sense together? Do they have a poor record of capital allocation? Have they had issues, recent accounting issues? Have they had to restate their financials? What are the things that tell me as an activist that they may have a shareholder base that's not happy, right? And then I look at governance. What's their governance structure look like? Do they have a corporate governance structure that's conducive to me agitating for change, right? Well, I mentioned before, there are certainly examples of activists targeting companies that had controlling shareholders. Those are the exceptions still, right? Still activists want to target companies where they can force change if they needed to. So what's their corporate governance profile look like? In two perspectives. One, what's their corporate governance profile look like and the impact to me as an activist and my ability to force my change? Do they have an annually elected board? If they don't, how many seats are up for election this year? Can I act outside of the annual meeting by written consent? All of these other kind of issues. And then, they look at corporate governance from how do the shareholders view their corporate governance? Is corporate governance a weakness, that I can leverage as an activist? We talked about, again, this theater and politics. Can I criticize their corporate governance as a way to get additional support from the index funds? Are there things that really, to me as an activist, don't matter for my campaign, right? But I know that they are kind of annoyances to BlackRock and Vanguard and State Street and Fidelity and T. Rowe Price, and so I'm gonna really highlight those in order to agitate those shareholders, right? So and then other issues around, what are their compensation practices? What's the CEO gotten paid? Is there a clear link between management pay and shareholder performance? Are they holding an excess amount of cash on their balance sheet? Building up these fortress balance sheets that shareholders view as providing too much insulation or buffer to a management team and not enough discipline. Do they have a poor M&A track record? Do they have a track record of going out and buying companies and then writing them off, or not being able to integrate them and destroying shareholder value? So those are all the ways that activists look at a company and go, is this going to be a good target for me? Is this going to be something that I can tell a story to shareholders about that I feel will resonate with shareholders and drive shareholders to support my again, you look again, some of the, just in terms of how we dig down into some of the things I talked about, in more detail, share price performance, 1, 3, and 5 year on an absolute basis relative to peers. We talked about a lot of this stuff already. In terms of on the right-hand side of the page, are there specific triggers, right? We talk about kind of long-term performance, a company that's just underperformed for multiple years in a row, but sometimes there are specific triggers where an activist will show up right away afterwards. You just massively missed earnings, right? And because you massively missed on your earnings, your share price just got hit. You just announced a transformative M&A transaction, right? And maybe an activist is going to feel like that is not the right strategy. That's a value destructive strategy, and they're going to try to come in and get in the way of that transaction before it closes, right? Just general market sentiment. Some other management issue is occurring. We're seeing that in a few companies right now in the U.S. peers of companies that we're working with right now where they've just fired their management team, they just fired their CEO, they just fired their CFO, and there were accounting irregularities. Those are all triggers. Those are all specific events that can trigger an activist to go, hey, I'm going to jump in here, and there's a way for me to move the share price. Again, what activists are looking for is there a story I can tell to move the share price one way or the other? The stock of a company is just an inventory. It's a widget to an activist. All they're trying to do is make it more expensive, and so they can make money that way. Or there are short activists too that try to drive the share price down, and they make money by trying to drive the share price down. So it can either be a specific trigger that induces an activist to show up, or it can be kind of just a general, longer term, sustained level of underperformance, a lack of a company to evolve as its industry has evolved, its peers have evolved. You think about retail, right? And companies that I'm seeing getting targeted right now. I've seen a number of companies get targeted where they didn't make an effective transition into kind of digital. They don't have an online digital marketplace. They're still trying to sell in brick and mortar stores, and those are targets for us, right? Most activist campaigns do involve criticism of corporate governance, and I mentioned that before, whether it's independence, board size, tenure, chairman structure, diversity. Again, that is very much focused on criticizing corporate governance really solidifies support from some key shareholder constituents, particularly the index funds. Remember, the index funds, they don't have a portfolio manager at the index funds that are evaluating the strategy of a company, that are your active fund, a Fidelity, a T. Rowe Price. Their portfolio manager may be building a model to try to decide, is the company undervalued, overvalued? What assumptions do I have about growth? The index funds don't do that. They don't have portfolio managers that are focused on the value of the company. They have proxy voting and corporate governance teams that spend most of their time focused on corporate governance, right? And so again, an activist will criticize corporate governance to really get to that proxy voting team at an index fund. And remember, kind of index funds are holding up to 30% of most companies' outstanding shares. So it's a very important constituency, probably the most important constituency when something goes to a shareholder vote. In activist campaigns in general, globally, the way that the index funds of a company vote typically is determinative of the overall outcome of that campaign. It's important that we understand what our shareholders' expectations are with respect to key corporate governance items, and that we understand if we're an outlier anywhere. And if we're an outlier, then we need to think about doing something about that. There are certain issues that change year to year. So it's just important that we keep up to kind of what's the latest, what and these funds, index funds, or even kind of some of the proxy advisors out there, ISS, Glass Lewis, Egan Jones, they're not shy about sharing what they view as best in class, what they view as being kind of outside the norm. We need to be aware of that. We need to understand where we fall within kind of the markets and particularly our index fund shareholders' expectations on corporate governance, and make sure that we don't have to be in line with absolutely everything they say, but we have to make sure that overall we haven't become a laggard and we become a target because we're viewed as so far outside the norm. And then ESG, as I spoke about before, increasingly driving activist agendas. Again, I don't personally believe that most of these hedge funds activists care that much around environmental or social issues themselves. I think, maybe I'm a cynic, but I think that most hedge fund activists only care about how they can make money for themselves and their investors, right? Not the company's investors as a whole, but the hedge funds investors. And so, using ESG as a wedge, using ESG as a way to garner support from shareholders that, like the index funds, that may not be able to really digest or understand the activist value creation claims, has been a very effective tool that activists. So how do we prepare? Like, what should we do about all of this, right? It's important that we prepare proactively. It's important that we think about shareholder activism vulnerability before an activist shows up, right? We have to almost be our own activist. You may hear people say that, hey, be your own activist, or have someone look at you through an activist lens, right? You know, a very independent analysis of the company performance, right? I think it's very easy if you're running a company every day from a management perspective, if you're on the board every day, it's very easy to overlook, or because maybe you understand the drivers of some key areas of underperformance, and you understand some of the impediments to fixing those issues. Sometimes you can almost become comfortable with, hey, we're doing what we can, and it'll take time to get there. I think you have to take an outside-in look at performance as if you weren't part of the company, and you know, from a shareholder perspective, from an activist perspective, they don't share those same attitudes of patience when it comes to share price underperformance. They may understand what's driving underperformance, business underperformance, they may not, but you know, generally they also just don't care. Particularly if your peer group is performing better than you, it's very challenging to convince a shareholder that, you know, there are legitimate reasons why the company is underperforming that the shareholders should be happy with. We have to develop kind of, you know, actionable alternatives to create value. And again, think from an outside-in perspective. If you weren't kind of part of this company today, would you think that, you know, the company really makes sense in its current form? Do these mix of assets make sense to you? Again, from an outsider's perspective, you really have to work hard to almost divorce yourself from what you know about the company and say, if I were just your average shareholder, would this make sense? And sometimes, you know, there are ways that we can help it make sense, but oftentimes it doesn't make sense to shareholders, and it may not make sense to shareholders, even if we try to explain it to them. They need to take some action. You know, again, board governance and ESG, you know, we can't become a laggard. And then kind of an investor engagement in activism. By investor engagement, it's you know, this is really, we talk about share price performance, company performance, ESG, all of these things, but investor engagement is probably the single most effective thing that a company can do to make themselves less vulnerable to an activist, right? Getting out there and having a really strong dialogue with shareholders around where the company is, the management team and the board's view of where the company is, and particularly if there is a performance problem, you know, being in front of shareholders and owning that, right? Going, hey, it's not acceptable. Our share price performance isn't acceptable to us. We accept that we're not performing in line with our peers. We accept that we're not doing a good enough job, is an important piece of the shareholder dialogue. And then marrying that to, and this is what we're going to do about it, right? If you can do those things and you can turn the shareholder engagement process into a two-way dialogue where shareholders feel like their perspectives are being heard, that goes a long way in helping to protect you from maybe not a shareholder activist showing up to begin with, but it goes a long way to keeping our own shareholders on our side and supporting the management team and the board versus supporting the activists. On the right-hand side of this page, if you just look at some of the actual discrete preparedness activities or work streams, I think kind of assembling and having an activist response team prepared today. So if you got a call tomorrow from an activist, knowing who your team is, both inside the company, who from the management team is going to be responsible for dealing with an activist, and who from outside the company is going to help us. And this is a really important lesson that's been learned by some companies that haven't done this, and the activist has shown up publicly, right? And they've gone on television, on CNBC, or they've leaked an article with the Wall Street Journal, and the company takes 3 or 4 days to figure out who their advisors are and maybe hire a financial advisor, a proxy solicitor, a law firm. And that whole time they're silent. We have to be nimble. You know, shareholder activism defense is about controlling our own narrative. And if we're silent for 3 days after an activist shows up, then the market just interprets that as the activist being right. And then we've already lost the narrative. So identifying and responding to vulnerabilities. We talked about evaluating those vulnerabilities proactively. And when an activist, shows up, evaluating the activist critique of the company. There's no monopoly on good ideas. And sometimes an activist does show up with something that maybe the company hadn't fully thought about before. I wouldn't say that's common. I think most of the time, the things that an activist shows up with or suggests are ideas that the management team has already thought about. But be open to the fact that, hey, maybe someone does have an idea I haven't thought about, and evaluate those ideas and be willing to take action, right? Or one of the things that gets a lot of companies in trouble in an activist campaign is when there's something that the company could do that seems pretty obvious to everybody, the shareholders, the activist, even the company, and they don't, because they don't want to be viewed as being pushed into it by the activist. Do the right thing. If you realize once an activist is there that the right thing to do is to sell an asset, sell the asset, right? Don't worry about how that's going to be perceived, because if everybody knows you should sell that asset and you don't, what is perceived is that you're entrenching, right? You're perceived as defensive. Developing an activism response plan. This kind of relates to kind of the first item I addressed here. Know what you're going to do if an activist shows up. What happens in the first 24 hours, in the first 72 hours? A response plan is not how do I go from the activist showing up all the way to a shareholder vote? What's that 3 months look like? No. It's what do I do in the first 2 or 3 days that allows me to control my narrative, right? That takes a very chaotic situation and puts some structure around it, right? Proactive or simulate a mock activist attack. Again, this kind of goes in line with what I talked about before, that independent analysis. But have an outside advisor. I do this all the time with clients where I will come and I'll say, let me come back to you in a couple of weeks. And when I come back to you, I'm going to have a 40-page presentation that is going to be effectively a mock activist white paper. I'm going to do all of the things an activist would do to help you understand, the client understand how an activist could tell a story about you. I'm going to redefine your peer group. I'm going to choose your 2 top performing peers, right? You compare yourself to these 10 companies. I'm going to take the 2 top performers. I'm going to call them your best in class peers, and I'm going to only evaluate you against those 2 companies, right? You look at the company on a 1-year, a 3-year, a 5-year basis. As the activist, I'm going to look at the company performance over the last 17 months, because that's the period of time that tells my story the best, right? So again, have someone tell you what an activist would say about you. And keeping in mind, again, an activist is telling a story to a shareholder that doesn't understand the business at an operating level. So you may see these activist white papers, or you may have an advisor prepare an activist mock attack deck on you, or like a simulation, and you may say, well, that doesn't make sense. But you have to elevate yourself up and go, oh gosh, but if I was a shareholder at Fidelity, if I was a portfolio manager at Fidelity, I don't run this business every day. So I see how that would make sense to somebody that doesn't understand the challenges of running the business. And then lastly, proactively, like I said, engage with shareholders. And engaging with shareholders does not mean going out to your shareholders twice a year with an investor presentation and flipping through 40 pages and then thanking them and shaking their hand and walking out of the room. Right? That's investor relations, or IR, from a decade ago. Today, proactively engaging with shareholders means walking through in an hour-long meeting, walking through your strategy presentation, right? But maybe only doing that for 20, 25 minutes, and then having half an hour, 35 minutes of dialogue, and us asking questions of our own shareholders. Hey, what are the issues that are important to you? how do you see our performance, right? Are there things that you think that we should be doing that we're not? Your shareholders want to feel like they're heard. They want to feel like they have a voice. Shareholders want to feel like even if you as a board or a management team aren't doing all of the things that the shareholder feels like you should be doing, they want to feel like you've at least taken their perspectives into consideration. That hey, gosh, I wish they do X, Y, and Z, but they took my viewpoint, and I know they took viewpoints of other shareholders because I know some of them and I talked to them, and they really thought on those things, and then they made some decisions about the future and the strategy of the company. I'm glad they listened to me. I wish they would have done more, but I feel like they heard me. And ultimately, shareholders want to feel heard. Best response. Now, if an activist does show up, what are some best responses or best practices if you do get a call? And it may be a call privately to a CEO. It may be a letter to the board or to the management team. It may be it may be a more public approach. But on that first approach, let's assume that it's a private outreach. It's important that we listen, right? We do not, everything, when you think about shareholder activism, again, think about theater and politics. We don't want to give an activist anything that they could use in their political campaign. So we should never refuse to speak to an activist, right? If an activist shows up, they're a shareholder, they own shares in the company, we're going to listen to them. We're going to listen to what they have to say. We never want them to be able to go out to the rest of our shareholders and say, hey, I tried to engage with the company and they wouldn't meet with me. They wouldn't take my call, right? So we're going to listen to them. We're going to listen to their perspectives. We're going to thank them for sharing their perspectives. We don't have to agree with their perspectives. We can vehemently disagree with their perspectives, but we listen to them because they're a shareholder. One of the things that we've seen get many companies in trouble is an activist shows up and the management team or the board thinks that they can push them away, they can stiff arm them. And particularly kind of as activism has evolved, as activism has evolved and as institutional shareholders, active managers, index funds have become more supportive of activists, the clear message that those shareholders have sent to companies is shareholder activists are shareholders first, activists second. And when a shareholder says, hey, I'd like to just have a conversation and share my perspectives, the rest of your shareholder base, your non-activist shareholders, expect you to listen to them. And again, not do what they say that you have to do, but just listen, hear them out. And listen, we can use facts to correct any material inaccuracies. If the activist is saying, hey, your revenue was only $10 million last year, and you go, gosh, what are you talking about? Our revenue was $13 billion last year. You can correct those factual inaccuracies, but you never want to get into a debate around assumptions. The activist says, if you did this, you could create all of this value. In that kind of first engagement with an activist, it's never productive to try to rebut their assumptions. Just hear them out, correct their factual inaccuracies if you have the data. But if they have a different view or a different perspective or making a different assumption, that's a judgment call. That's their prerogative. We're not going to try to convince them they're wrong, because ultimately all we're doing is giving them a preview into how we're going to try to defend ourselves publicly. Focus on shareholder value creation. Everything we do and every interaction with an activist or with a non-activist should be framed in the sense that as a board and then as a management team, our primary focus is to create long-term sustainable value for all shareholders. That's what we do every single day when we come in, right? And then, we have to maintain composure, right? And again, this is an area that for some activists, this is a tool they use. They say things that are offensive in meetings. They send these letters that are really offensive. You're the worst CEO I've ever seen. You've destroyed value at every company that you ever worked for. And they say these things to try to get a response, to try to get something that they can use then in a campaign later to show how emotional you are, how kind of non-shareholder focused you are as a CEO or as a director, how you're focused on empire building and control and power versus doing the right things for shareholders. Maintaining composure is incredibly important. So again, we talked about a lot of the effective activism preparedness before, but education, understanding activism, identifying the risk, taking action to mitigate that risk, whether it's selling an asset, evolving our corporate governance structure, engage with shareholders, make them be heard, and then prepare and practice, have a break the glass plan in place in case an activist shows up, and be prepared. So with that, let me just pause there and turn it over. I may have gone a couple of minutes over the time, but turn it over back to Christian and the team, and maybe go for some Q&A and some further discussion.
Okay, thank you very much, David. Very interesting, very good conversation, good analysis. And let's start with our panel. And also, if you, for the people who is here, you can set the Q&As. We will have time to discuss. First question for Agathe. Agathe, do you think that this is an issue that is on the agenda of the board of directors in Chile? How do you see this discussion in Chile, or maybe the concerns in the board of directors?
Yeah, first of all, good morning to everyone. And thank you, EY and Christian, for this invitation. You cannot imagine for years what would be to listen to a French woman living in a Spanish-speaking country for 30 years and today speaking in English. So prepare your ears for. Well, for me, it's not a very present issue on the agenda of board in Chile. David has shown the statistics now in Latin America, and the numbers are quite low. He told that in South America, there was only one case during 2020. So it's a very small phenomenon. I would say that there are very few cases, and it's more about maybe active shareholders. For instance, the institutional investors at the AFP, rather than activist shareholder or shareholder activism, But nevertheless, there is a big difference, I think, between Chile and the US, because in Chile, most of the companies have controlling shareholders, and they are the ones who strongly used to influence the administration of the company. But I think that it doesn't mean that it will not evolve. And David explained that the activism began in US and then in Europe and then spread to Asia. And it's probable that this trend will arrive to Latin America quite soon. So I am a little afraid because the economic climate due to the pandemic and the social events in October last year may have destroyed the equity value of the company. And this may raise investors' disenchantment. And therefore, I think that it can lead to a highly contentious proxy season. But maybe we have to look at activism through more optimistic lenses and look at it as a big opportunity, because sometimes activist investors really add value to the company. And as David recommends, before the phenomenon strongly arrives to Chile, I think that it's really relevant that board and board members prepare and train, as I should say, in many other issues like cybersecurity, digitalization, governance, strategy, leadership. So the training, the preparation is crucial.
Yes.
Can I add one thing to that, Christian?
Yes, perfect.
What I think it important, and Agathe made very, very good points. But I think that, I look back at my experience and I look in terms of how activism develops in a new market, right? And I'll just give you an example. I won't name the name, but the company name, but I was traveling, gosh, probably 8 years ago. I was meeting with clients in Japan. And at the time, there really wasn't any activism in Japan. And I was talking about this need to be prepared, right? And how the world was changing, and how shareholder bases, where particularly outside the US, were looking a lot more like US shareholder bases, but even domestic Japanese shareholders were starting to express the same sort of frustrations with some Japanese corporates that US shareholders had for a decade. And the response I got from this the very well-known Japanese company that you all know the name of, I won't say it here, but you all know the name of this Japanese company, was, "It's different here in Japan. You don't understand. Japan is different. Culturally, we're different. Our shareholder bases look different." Right? This is a very interesting conversation about shareholder activism and this US problem that you have. Thank you very much for coming to Japan and sharing this US problem with us and having this conversation. But we're not worried because it's different here, right? And the next day I'm on a plane flying back to New York, and as I'm on a plane, that same company gets attacked by an activist shareholder, right? And so the message is really, it's different until it's not. And the one thing that's the same about shareholders all over the world, right, is at some point, if they feel like the shareholder value just hasn't been there, if share price hasn't materialized, if share price hasn't increased, and they're sitting on kind of a flat equity position over a sustained period of time, at some point, those shareholders are going to want change. And that's what allows an activist to come in.
Yeah. And I think, David, there is a difference between what happened in the United States. You speak a lot about theater, like an activist is an actor. And for me, in Chile, if they are activists, I think that they are less actor and maybe more rational, more fixed on the real vulnerability of the company and less theater. Maybe I am wrong.
And also, let me compliment you, but
yeah,
do you consider that it's a kind of activism, the group of pension funds, because they talk together and when they have problems and when they see something that they don't like, if any company, they go as a group of pension funds and attack for environment situation. We had here some kind of attacks when they do consider that the company, they are not doing well in environment, for instance, and things. And this is what we have seen more in Chile, as a group of people claiming for their rights, claiming for right things, but this is what really we see here, because they represent a portion of the minority shareholders. Because as Agathe mentioned, here we have the majority shareholders with control, but who represent in general the voice of the minorities are the group of pension funds.
Yeah, I think that's right. And I think, Agathe, what you're describing in terms of activists locally being more realistic and being more focused and less theatrical, I think what you're describing is very much what the US market was a decade ago, where activists were coming in and saying, hey, you have a 200-point margin gap to your peers. What are you doing about that? Hey, you're not growing your top line at the same level as your peers. What are you doing about that? And I think the US market evolved into this more theatrical market, and we're seeing that evolution. We're in the middle of that in Europe. We're seeing the early parts of that in Asia. And I do think it's important that when we, and I'm certainly, I should probably preface a lot of my discussion with this, but activism is not one strategy, right? There are the highly theatrical activists, but there also are, to Agathe's point, activists that are very smart, very focused on the company and really want to understand the company. When I talk about activism preparation, you know, I feel like clients need to be prepared for that theatrical activist, because that's the worst type of activist. And if you're prepared for that activist, then you're already prepared for the other types of activists. But activism is not one simple strategy. It really depends on the individual activist.
And David, the shareholder activism can often be seen as a negative, I imagine, and for the company in the long run. Should the board approach this as a challenge rather than a threat? How do you see this to manage from the board of directors?
Yeah. I don't think that the board, I don't think viewing it as negative or positive, particularly before an activist shows up, is how the board should view this, right? It's a threat, but at the same time, it's an opportunity, right? And what I mean by that is, one of the reasons why the market has accepted activism, and why in large part, even though the data over the long term, if you look at what happens to companies after an activist shows up, the year after or 3 years after an activist shows up, oftentimes those companies perform slightly better than the market. 5 years after an activist shows up, most of those companies are underperforming their peers 5 years later. But the reason that the market in general and why shareholders still believe that activism is a good thing is because we're having these conversations like this right now, right? Because boards are being more proactive in looking at their structures. They're being more disciplined with respect to oversight of management and ensuring that management are performing and taking more decisive action. And I think the threat of activism, and the discipline that's implied through the threat of activism, and the higher levels of discipline that boards are exerting over management teams, that's something that investors think is a good thing, right? Hey, if a company is more focused on delivering shareholder value and boards are less patient with a CEO that consistently underperforms because they're worried an activist might show up, that's good, right? So that's I think how the board should kind of look at this more broadly. Now, I think it's also an opportunity, right? It's an opportunity now that I've seen boards use as an opportunity to transition a management team where the board feels like we do need to take a new direction. I think that we've seen a shift back towards boards taking more ownership, right? And we all saw for quite a long period of time, many companies where the CEO was also the chairman, controlled the agenda, and really kind of the company went wherever the CEO wanted it to go, and the board agenda was controlled by the CEO. We're seeing boards take back more control and really do what boards are expected to do, which is kind of oversight of management. But again, I think it's an opportunity for boards to take a fresh look, to take a look at the company and its performance and strategy in a way that, without an activist or the potential that an activist may show up, boards may have been hesitant to do so for fear that it might, alienate the board from their management team or their CEO or what have you. But it's really, I've seen a number of boards see this as an opportunity for them to take action that maybe individual directors were talking about privately, but just didn't feel like it was the right time, or they didn't have the right kind of catalyst to be able to actually activate on something.
Excellent. We have interesting question from the public who is here with us. One of them, Pablo Fuentes, asks, could you please provide a noticeable example of activism in the US company and how it was solved? An example of
and how it was solved.
No, or yeah.
Listen, I've
More than so, an example of the case, any case that you can remember of an activism in the US, and how was managed and solved?
Yeah, I mean, listen, lots of examples in the U.S. I mean, I can give examples of situations where the activist was actually probably right. You know, I worked on, this is before I joined EY, I defended Yahoo when Starboard Value showed up at Yahoo. And, you know, Starboard was very critical of their CEO there, Marissa Mayer. Really had talked about, you know, Marissa destroying a lot of value. It was, you know, public knowledge because, you know, the counterparty, you know, made it public that, you know, Yahoo had turned down an acquisition offer years prior, and that would have valued the company at many multiples of what the company was trading at when the activist showed up. And ultimately the activist was arguing for the company to be sold. Because their view, the activist view was, you know, and this was a couple of years ago now, Yahoo was in a position where its business had declined so substantially, it was never going to be a search powerhouse again. Like that business had been ceded to Google, and you know it had a few assets like Yahoo Finance and a few other assets. Like Yahoo Mail wasn't really a player anymore, and so ultimately, kind of, it became very clear that that activist had a lot of shareholder support, right? And so we settled with that activist. We put Jeff Smith from Starboard Value on the board, and the company was sold shortly thereafter. The rest of the board recognized that what the activist was saying was right. They didn't have a lot of shareholder support, and so that's a situation where an activist came in and actually was pretty logical. And I'll give you an opposite situation. I worked for a company called Monotype. And not a company you'll probably know the name, but you all use their product every day. So Monotype owns fonts. They own Times New Roman. They own Courier. They own Arial. Right? So all the fonts we use in Microsoft Word and PowerPoint, they own those fonts. And so Microsoft and all these companies and Adobe pay them royalties to use those fonts in their products. Same activist, Starboard Value, came in and said, you should sell the company. You should sell the company. And you know, think of a company like a font owner. There are only a couple of buyers for a company like that. It is Microsoft, it is Adobe, and then a few of the private equity houses that focus on intellectual property. And what we hadn't been public with at that point is that we had been trying to sell the company for 6 months. We'd had management presentations, and so I'll fast forward, but it got to the end, and Starboard nominated to take control of the entire board. And you know, I'd kind of got on the phone with the activist and was trying to negotiate, and what I wanted to do was I said, sign an NDA so we can tell you something that's really important about your campaign. He said, no, I don't want to sign an NDA. Assume that I already know what you want to tell me. So he was insinuating to me, I know that you're trying to sell the company, right? Or I know that you tried to sell the company. By this time, the sales process was done. Assume that I know what you want to tell me, that you tried to sell the company and failed. I don't care. I want you to make a public announcement today that you are in the process currently of selling the company. Not that you tried to sell the company, but you're still running a process to sell the company. If you do that, I'll withdraw my nominees. I'll end my campaign. What he was trying to do is get the company to put a press release out to say that we're running an auction process that would have a positive impact on the share price, even though he knew the auction process was dead, that we hadn't sold the company, nobody had shown up to buy the company, right? And so, you know, I said, well, we can't do that. I went back to the board of the company, and I told them, I said, this is what I want to do, and it took a lot of work to convince them, but I said, we're gonna issue a press release tomorrow. But that press release is going to say, we tried to sell the company over the last 6 months. We had, you know, we sent out 35, you know, teasers. We signed 20 NDAs. We had 9 management presentations. We got 2 bids. Neither of those bids compensated shareholders versus the current share price. And that, you know, why is a board nervous about that? Because you would expect you go out and tell the world that you tried to sell the company and you failed. You think the share price would fall, right? The share price actually went up a little bit, right? Because shareholders appreciated the transparency. They appreciated, and it was clear that the company was doing exactly what shareholders wanted them to do, which is explore all alternatives to potentially create value for those shareholders. The activist, Jeff Smith, called me in my office 5 minutes after that press release crossed the wire. He's yelling at me and swearing at me, and I'm going to sue you, and this and that, no basis. And then 2 hours later, he sold his entire position. Right. So that's a situation, and withdrew his campaign. So that's a situation where, we did the things that shareholders wanted us to do. And we engaged with shareholders to let them know that, gosh, we wish the share price was higher. We explored other alternatives. If we could have gotten a premium to where the share price is trading today, we would have sold the company and given you that money. But what it did for shareholders is we got this feedback from shareholders. Gosh, we're disappointed that you weren't able to sell the company, but we now have confidence. The management team now had credibility with shareholders that they were doing all the things that shareholders wanted them to do in terms of maximizing value.
Interesting. Thank you, David. Agathe, how does the board of directors has to approach this issue from the strategic communication point of view?
Well, for me, there are 3 steps. The first of all, and David insists on that in his presentation, is prevention. This makes a decisive difference and should be the first focus. And that means that even if the risk is low, which is the case in most of the company in Chile, the company should be prepared, should work on simulations, So to prevent, what we have to do first is to identify potential vulnerabilities. And a lot of studies show that the 3 factors most likely to make a company a target for activists are a weak corporate governance, David presented it, a lack of confidence in management, and a poorly articulated business strategy. Settlement is a big issue. There are otherwise ESG can be a big issue too. So first, we have to prepare to make simulation and prepare the company identifying vulnerabilities. Then we have to engage with the shareholder very proactively. And for that, the company should use inbound communication and outbound communication, because both play a decisive role. So when I say inbound communication, I'm referring about understanding and monitoring the investor's sentiment, and then transmitting to the board. And then about outbound communication, that means shareholder communication and interaction. It's not just about speaking or giving a content to the shareholder, but it's about interacting. And David told us that face-to-face is very interesting. So it's well known that continuous engagement with the investors is one of the best way to fortify support for management strategy, and more important, maybe shut up concerns that activists can exploit. So I think that sustainable shareholder communication can help to change the negative feelings and can allow to obtain support. You know that boards are increasingly asked for greater transparency. Before we spoke about black box company, and then today people want glass box company. So do it. Show investors that you listen to them and take their concerns seriously. at heart, you know. And of course, you have to figure out investor relation campaigns and use media tactics to support them. And the last point is when there is an attack, because sometimes you cannot preview an attack. So you have to figure out quickly an appropriate communication campaign to defend against and overcome the activist threats. And parallelly, which take a lot of time and concentration because it's really sensible, you have to figure out the content, targeted to the shareholders, but also to stakeholders, you know, your clients, vendors, regulators, politic groups, and so on. And obviously, at the end, manage actively the media relation.
Thank you, Agathe. Another question from the public. David, you spoke about what activists do and not do, how to be prepared and respond. My question is, who are these people and what is their ultimate goal?
Maybe clarify who are the activists?
Yes.
It's hedge funds primarily. I mean, there are other non-hedge fund activists. There are climate change activists. You know, there are federations of pension funds, you know, like Change to Win, that have an agenda as well. But when I'm talking about activists, I'm talking about activists that are trying to impact the share price, and that's primarily hedge fund activists.
Okay.
And again, it's individuals. I think, again, activism, when I talk about starboard value, I'm really talking about Jeff Smith, the fund manager. When I talk about Third Point, right, I'm really talking about Dan Loeb, because it's the personalities of the fund managers are really the important part here, because that's how, you know, their strategy, their, you know, hear the word playbook. It's important that you think about these specific activists and what they want to make money. That's the only thing they want, right? So again, they may say, you know, you have, you know, horrible corporate governance and you should do this on your corporate, like, they don't care. Like, the hedge fund does not care what your corporate governance structure is, except if it's bad, if it's a bad corporate governance structure, a shareholder unfriendly corporate governance structure, in many ways, the activist likes that because they can use that against you, right? But in and of itself, you know, Third Point, Starboard Value, Carl Icahn are not trying to, you know, change the world's corporate governance structures, and that's what makes them feel good about themselves every day. They're trying to make money for themselves and make money for their investors, and that's a really important point. Not the company's investors, other than themselves, the fund's investors, their limited partners.
Interesting. Another question from the public is Alejandro Albastro asking question for all. Is there any evidence of what kind of leadership is more effective to manage activism? Moving a more inspirational leadership surely will support this agenda. How do you see this?
I think Agathe made a really good point around this before. It's more about credibility than inspiration, right? You know, what shareholders want to see is, to her point, a credible strategy and a management team that has credibility in their ability to execute that strategy, right? And listen, there's certainly an inspirational CEO, an inspirational leader can have a positive effect, but I've found many instances where you know, a CEO feels, or even the entire organization feels like their leader, their CEO, is inspirational, but the market kind of views that more as hubris, right? That they're more inspirational to themselves than they're inspirational to the market. And oftentimes those individuals don't recognize the fact that, you know, they're not being perceived as inspirational, they're being perceived as pompous, right? They're being perceived as insular. And so I think, you know, more focus should be on, hey, how am I credible? You know, do I do what I say? Do I have examples? You know, a CEO that can say, listen, over the past 20 quarters, I've hit the numbers that I laid out to shareholders every single quarter over the past 20 quarters. When I thought we were going to have a problem, for whatever reason, I was transparent with my shareholders before that problem occurred. Hey, it looks like we're running into some headwinds, so that it wasn't surprising to shareholders. I think shareholders value credibility, right, and predictability more than they value somebody that's out there and, you know, as a larger than life person.
Okay, another question from Rodrigo Morales. Have you ever faced an aggressive stockholder activism that also spread some fake news before his action to reinforce his action? The point is how to deal with fake news spread in social media to false attack the board.
Yeah, the example I gave on Monotype was exactly that. You know, one of the things that activist did is, you know, he was publicly stating that he had been in contact with all of the potential strategic buyers for the company, and that we were not returning their phone calls, those potential acquirers' phone calls. We weren't engaging with them. We weren't returning their emails. When in fact, those exact potential acquirers had been in the data room, had been present in management presentations. And so part of why this activist was so angry at me personally when I got the board to, you know, send out this press release saying this is the sell side process we've run over the last 6 months, is it exposed him for the fact that he had kind of made that stuff up, right? And also what you often find in a lot of these activist claims around the quote unquote potential value creation, you'll see the same 2 words, right, preface across multiple activist campaigns, different activists, shareholder letters, white papers. You'll see the same 2 words over and over and over again. And it starts with, we believe, right? Because that's what they can say. Well, we believe that there's 80% upside from where the shares are currently trading today if the company would just do X, Y, Z. Because that protects them if they're wrong. It's like, well, that's what we believe, right? I guess we were wrong. I guess, well, we didn't have this information. We didn't have that information. So it's almost, you know, we believe there are multiple strategic buyers out there for this business, right? And then they don't really have to back it up with anything beyond that. And so we see that quite often. Again, that's part of the theater of activism.
Okay, we are on time, and really thank you very much for our panelists, David and Agathe, for their interesting perspective and also for the question of the people who is seeing this webcast. The webcast will be available on demand on our website and social media. Now we have come to the end of the webcast, and we only thanks all the attendees for their participation and invite you to continue accompanying us for the future initiative of the IdDC, Instituto Directorio de Chile and EY. And thank you again, David and Agathe.
Thanks to you.
Bye-bye.
Bye-bye. Have a good day.
You too.